right, everybody, we have a special guest, Ruben Izgelov, with me today on the podcast. Ruben and I exchanged the emails, some contacts. Very interesting story that I would love for everybody to know and find out more about Ruben's business. I'm pretty excited. Ruben is the co-founder and managing partner of States Capital, a private real estate debt fund, as well as he is the president of We Lend LLC, a national private lending platform. So Ruben probably sees a lot of inflows and outflows of how the private capital is flowing. I would love to ask a lot of questions on the sources, who plays in this market, the economical aspects of who is qualified. So there's a lot to cover. And just to finish on Ruben's resume, he has a huge experience in acquiring, flipping, developing, and financing over 500 million in assets. So that's pretty big amount. Ruben, welcome to the podcast.
Thank you so much, Alex. I really appreciate you taking the time. And yeah, I mean, hearing what you're saying about me, I kind of had to pinch myself for a second. It's like, wow, 500 million. I mean, thankfully, we're now almost at 700 at this point, but it's forever growing. It's a moving target. But thank you so much for having me. It's a true pleasure to be here.
Absolutely. Let's get started. Where do you want to start? Economy first, top down?
Wherever you would like. You're the host. I'll kind of follow your lead. I'm happy to delve into anything specific.
Yeah, so let's start. Most of my audience are mortgage market professionals, capital markets originators, real estate professionals, economists, vendors. So let's touch on, the what do you see from the rates, access to capital, affordability on the economical fronts, and how does it translate to people knocking in your door?
So, look, I mean, what we've seen a little after COVID, right? I mean, obviously, we've seen a huge dip during COVID, but then after COVID, we saw a huge uptick in pricing and in rates and in cost of capital, right? And the increase was so significant where a lot of our borrowers who were agency type borrowers, who were conventional type borrowers, realized and learned quite quickly that the cost of capital is not that much different from conventional agency versus bridge financiers like us. So it doesn't make sense for them to have to go through all that red tape of getting capital from agency lenders or what have you. It makes sense for them to go through that process with a bridge lender to get financing from us because there's just not as much red tape, right? I mean, bridge lenders like ourselves in the private credit space, we can originate deals as quick as 12 hours, right? Generally speaking, we work on a 5 to 7 day turnaround, but I've seen deals fund as quick as 12 hours. Obviously, they're not on the $20 million acquisition or anything like that. They're usually for the smaller deals, anywhere between a $1 to $5 million range. But I think a lot of the borrowers with the rates going as high as they have are realizing that it makes sense for them to work with private credit providers. Now, the question then becomes affordability, right? A lot of our client base, a lot of our borrower base, they are in the business of fixing and then ultimately exiting out of the properties. Today, or I'm sure we'll touch on this, a lot of our borrowers, instead of flipping the property, they're adding it into their portfolio through all the major takeouts that are available today, like the DSCR programs, the PNL programs, the bank statement programs, and so on. So essentially what happened there is that the affordability for end users, it doesn't really align with their cost or their income, right? The cost of capital, the cost of buying a home did not grow or grew much faster than people's incomes, right? And as a result, in addition to that, right, the fact that their income did not grow as fast as the cost of capital, supply, there's a huge deficit, right? I mean, supply and demand, it's economics 101. If there isn't enough supply in the space, in the market, and I think, if you read some studies, it shows that we have a supply deficit of at least 2 million homes. Some show a 10 million homes, a deficit of. So, a supply deficit alongside with a cost of capital increasing the way in which it has. And then in addition to that, the income not growing as fast as the cost of capital has grown, really, really put a damper on affordability for end users. And I think that, a lot of investors, borrowers, clients of ours or other private credit institutions took notice of that. And they said, you know what, instead of us exiting with a fix and flip or with an exit strategy of a resale, we're going to hold on to this property and rent it out. Because guess what? As the cost of housing goes up in terms of a resale and the value of the house, so do the rents, right? Today rents from some of the studies I read are beyond 40-50% of people's incomes, right? On an annualized basis.
And it's still lower than the purchase of the house, right? So somebody who is renting pays less than if they would pay the mortgage in the house.
Yeah, I mean, that's one part. I think the other part that a lot of people are struggling with is the fact that there's a cost of entry of owning a home, right? You have a deposit, you have a down payment, and then obviously the carrying cost. Being a landlord is a lot more expensive than being a tenant. And a lot of people I'm noticing are starting to buy multifamily, and their viewpoint on it is, well, at the very least, the second or third unit will help me pay for my mortgage. Well, the question that happens, especially if you're in New York or in a blue state, what happens if the tenant stops paying you and you were relying on that, right? I've spoken about this multiple times on a number of different podcasts. We are operators here in New York. We're not only lenders, we're also landlords, and we've had tenants that haven't paid us in, as little as 2 years and as high as 5.5 years. What are you going to do about that? With the policies and the politicians in office today, many of whom are my friends, it's hard to navigate in a blue state kind of operation, right? Especially when you're relying on, if you're a new landlord, you're relying on the additional flow of income from those other units, let alone, your income has not risen as quick as the cost of capital and operating and the carrying costs of a property. So it's one.
Not to mention the capping of the rents, right? So New York is famous for capping the rental increases.
Exactly. Exactly. I mean, it depends on what type of property you're in. But I won't be surprised if that kind of bleeds into other properties that are not stabilized or controlled. I mean, the Mamdani effect is in full effect. I was on the phone with a capital provider. Look, we on our end are managing a little over 100 million of assets today in our fund, but we rely on working relationships with other private credit funds and private debt funds and other hedge funds and institutions, family offices, and so on. And the bulk of my business today, the bulk of the loans that we made today are in New York, right? But when you're speaking to groups they may be New York based or not, and you're telling them, hey, a good bulk of my business is New York based, that's where most of my loans are. They're saying, oh, call us in 6 months.
Yeah, to them it's poison. To them it's poison.
It
Yeah.
really is, and I just feel like he's not even in office yet. What is that going to do to the market once he is and he has a full 4 years? We'll just kind of cross our fingers and wait for it and hope for the best.
Yeah, so one of the examples that I've seen, specifically on New York market, if you remember Signature Bank closure and a lot of multifamily units that my firms did the pre-sale diligence on those before it was sold
Impressive, by the
to.
way. I listened to a podcast where you mentioned that. I mean, that is impressive to be a part of, right? So
Yeah, it's well, we have a contract with FDIC, so we are a part of any bank closures that happen, and most of those are rent controlled, where folks that typically would grab those assets for multifamily commercial, they stayed away. They said, we don't want New York. We don't want multifamily rent controlled buildings because we don't know if whatever we invest will get out. So it was poorly bid. In fact, it was not traded the way FDIC hoped, and they had to do retrades and retrades and splitting into smaller pools. But that's the cost of the business in New York. People are just staying away.
and was that before the new political force that, is on the horizon of coming in, or is that after?
Oh, it's to me every year it gets worse and worse. Yeah, because the governor would institute the poor foreclosure laws in New York, and it will not foreclose anything. Judges will not foreclose anything in Staten Island or it takes forever to foreclose in the boroughs. It just
When you do well. I heard your podcast yesterday, with I believe his name is Tim. I know from the NPLA conference, I get his emails. I mean, what's happening in California, it's horrible, right? I mean, how do the politicians expect the world or New York or their state to operate if investors are fleeing from those states? Right? I mean, that means there's no income, there's no flow of capital, there are no loans. There's no income for the businesses that are dependent on people coming into those spaces, into those areas. I just can't understand what's going through their mind when they're so against business, right? It just it doesn't make sense. And I think that a lot of times when politics tries to get into regulations of businesses and of private, the private world, I think that's what ends up happening is that a lot of people start fleeing from those states. And I was speaking to a friend of mine who's in California. He said the first ever record of a net loss of people in California was in 2020, late 2024, early 2025. That means that more people fled from California than people actually moved in. First time for the record, right? I mean, it just shows you what's happening with this world that we're kind of entering into, and it's concerning for a person like myself. Not only am I thinking, should I leave New York? I'm starting to think, should I leave America? Right? Like, is has the time come where we need to start thinking about this kind of stuff? And I don't mean to be like that negative kind of person, but like realistically, we need to start thinking about this.
Yeah, we talked about it with my wife, and the thought crossed our minds. But we travel the world quite a bit, and I can tell you that no other country offers the same protections and laws that the United States. To me, I'm a big supporter and patriot, and anything I can do to improve the country, meet with politicians, offer the programs, participates in the. One of the things I do is CEO roundtable in Washington D.C., where some of the politicians and CEOs from the mortgage industry get together and discuss all kinds of issues and brainstorm on proposals. No media is allowed, no pictures, no nothing, right? And so to me, yes, probably to visit other countries is good, but for us
Absolutely.
being entrepreneurs, U.S. is probably the better country out there.
I I agree, and I don't disagree on the fact that that statement is very strong, but these are thoughts that are already coming to minds of the people that are actually in the world of business and are actually investing into America, right? I mean, it's a concern, it's a trigger, it's a light bulb that's going on in the thought process that's actually already happening. It's getting scary.
But that creates an opportunity for both of us, right? So you looking for migration of folks from New York, from California to Nevada or Florida or Georgia, and there's certainly an opportunity for somebody that buys the property during their relocation. That it creates an opportunity for you to originate a loan to fund the transaction. Folks that are moving to from New York to Florida are investing in real estates. They're investing in multifamily, so they need bridge loans. They need the DSCR loans. So I think it creates a lot of opportunity for somebody like you to come in and offer those type of services nationwide, not just New York. And New York is still an opportunity state because everybody's staying away. Maybe there's still opportunities there to be in the state and originate in the state, but certainly nationwide opportunities are still out there. um, and just to um, comment on your affordability issue, most of the clients that you deal with are businesses, right? They're not
Correct.
individuals.
Yeah,
Okay,
yes, we only lend to entities, but
okay.
there's obviously principles behind it, but yeah, only to entities.
So it's DSCR fix and flip loans, right? And private loans.
Yeah.
So therefore, folks that I mean, you underwrite a loan in 12 hours. That's pretty fast. Uh,
It is, and that's an all hands on type of loan, right? But yeah, we've had scenarios where we had to close under 12 hours. 24 hours is 36 hours is pretty common, right? Where we get a call from a borrower saying, "Hey, you got to close quick." But that's the difference between a bridge lender, who's managing the money directly in house versus any other lender that has to go through a ringer and a rosy to be able to get the funding.
So how do you underwrite it? So that's curious, right? So what do you look at the first first couple of things that you look at to say, oh, I can underwrite this loan in 12 hours?
It's a very good question. So the first thing I look at is the main thing, the asset, right? We look at the asset first. We kind of take a look at the property, see where it's located, what it's about, what's the plan, what are you buying it for, what's the renovation budget, the capex, the construction, what's the exit, how is that going to happen? Once we kind of go through that process and make sure the numbers are realistic, if you're buying something for hypothetically $1 million, you're going to put another $500,000 worth of work into it. You're all in, not including carrying and financing costs, is going to be 1.5 million. What's your exit here, right? What's the resale value? What's the after repositioning value, after repair value? So we look at the asset, we make sure the deal makes sense. After that, we look at the borrower, right? The principles behind the entity, right? Because we're only lending to entities, but our loans are mostly guaranteed, personally guaranteed by the principles behind it. So we look at the sponsor. What's their experience? Have they ever done something like this? We do a background search on the borrower. We do a credit search on the borrower, credit check on the borrower, make sure that they have good credit. You check their background to make sure they don't have any financial crimes. That's huge for us, right? If there's any type of financial crime, it's a denial right away. We don't care if we're even at 15 or 20% leverage. We're just moving on with that deal, right? We're looking to see if they have any bankruptcies, past bankruptcies, foreclosures. And if they do, depending on the scenario and the time that has passed, we ask kind of questions, follow-up questions on that. But we first look at the asset, we look at the borrower, and then we look at the exit, right? A lot of times our borrowers ask us, well, Ruben, why are you checking my credit? What's the purpose here, right? You're giving me 75% of my purchase price, which is already discounted because I'm buying a property at a really good price. So you're at a very safe kind of basis going into the deal against the as-is value. What do you need my credit for? What are you doing? What are you checking my background for? Well, there's multiple reasons for that. But the main reason to that is one, I want to make sure that I'm lending to someone that's creditworthiness, right? They have that ability to get credit, not only for me, but on their exit, right? Especially with the DSCR introduction, which has grown significantly lately, right? For some private lenders like myself, it's almost 50, 60% of our business today, right? But we look at your credit not only from a perspective of do we want to lend to you, but will you be able to take out our loan in the event that you cannot or choose not to resell the property, right? So we kind of stress test it to make sure that in the event that you cannot sell the property or choose not to, you can still exit out of the property.
So you do the full blown tri-merge credit report and
Oh,
you view. Okay.
yeah. And look, from time to time, our borrowers, they'll come to us with a full tri-merge, pull from another broker. So long as we know the broker or we've met them before, we jump on a call with them, make sure that it's truly a real credit report. We may even work with that as well.
Okay, interesting. Do you require personal guarantee for most of your
It
loans?
it depends on the loan size. I would say out of the 700 million that we've originated across about, 1,000 loans or more, I would say 9 out of 10 of them were person guaranteed.
Okay, so that's an additional safety blanket for
Oh,
somebody that might
have
go
to.
delinquent.
Look, I mean, we're dealing with our own money, friends and family money. We obviously have some institutional capital as well. We have to cross every T, we dot every I, but we try to do it as fast as possible, right? Like we have an all hands on meeting. A lot of institutions or private credit funds like ourselves, we work day and night, right? If you call us, I've had scenarios where a borrower called me at 11 o'clock at night on a Sunday. We have to be at the closing on Monday, right? So it happens. And the only way that you can get that done is being able to be agile and flexible and work fast.
Interesting. Now, let's touch on the interesting topic of the one big beautiful bill, which is people say, well, why is that related to our discussion? There's the provision of opportunity zone credits, right, and tax write-offs, which opens the door for somebody to come in and start building either the multifamily commercial manufacturing plants and opportunity zones to get them an additional 100% bonus depreciation on the investment. So is that something that you see an uptick with people knocking in your door and say, hey, not only I'll build the or fix and flip the property in a poor neighborhood, it's also an opportunity zone, which gives me an additional kick towards the sort of uh, review of my exit strategy for not only personal guarantee but also an opportunity zone tax credit.
Tax incentives. Yeah. I mean, look, we're not seeing much of that today. I think we should be, in my opinion. But I think a lot of our borrowers today, they're already purchasing these properties at such a huge discount. A lot of our borrowers, especially for us, we lend, I would say 80% of our borrowers are experienced operators who only buy, fix, and flip real estate. They don't have any other full-time job, right? This is all they do. So they're already buying properties at such a huge discount, at such a safe basis that tax incentives, obviously, everyone wants, but it's not really that major of an impact for them to make that decision. So a lot of those discussions are not really happening here with our borrowers. It should be though. But I think also it's because of our average deal size. Today, our average deal size, if you look across the board, is right around eight or $900,000. Opportunity zones, I think it really makes a very big impact on deals much larger than that.
Sure. That makes sense. And now, how does the state's capital fund play into it? Do you also offer the investment from the external sources, family offices, where they would be, GP first year, LP next year, the usual sort of scenario where they would benefit from the tax structure and write-offs?
So we have multiple kind of scenarios. So States Capital, first and foremost, is a private debt fund. We don't do any kind of equity plays, right? We're only lending to groups who are actually buying, fixing, flipping, developing, repositioning, what have you. So we wouldn't really play a role on the equity side. So there's no like depreciation in terms of the tax incentives that come along with it. But there's a lot of family offices and institutions that have been attracted to this space because let's be real. I mean, this is the golden era of private credit. I mean, with all the regional banks that have been kind of pulling back, selling all their loans and moving their loans out of it because of all the new well, not tax incentives, but all the new kind of regulations that come along with what happened recently. So there's a lot of opportunity when it comes down to private credit. You're able to make equity-like returns while being in the safest part of the capital stack. And a lot of groups have been pouring their money into the private credit space. I mean, it's no longer Main Street. It's almost like Wall Street at this point, right? So to answer your question is we are working with a number of different groups. We have the ability for a group to invest into our fund and have and receive passive monthly cash flow. And we also have the opportunity to co-invest with other groups, right? And I think there's been a huge uptick in that, especially family offices and other private credit funds. They want to do essentially kind of syndications, right? Same way as someone would buy a property, and syndicate it with a number of different investors. There's a lot of private credit funds that syndicate loans. I mean, if you look at some of these deals that are untraded and so on, that are funding deals at 300 million, 500 million, I could tell you there's one lead group, but there's probably another 10 lenders or private credit funds that are alongside that lead group, right? That are essentially pooling their money together and ultimately funding that deal. So we've seen a lot of uptick in that. The groups that we're working with today and that we're having conversations with, I mostly kind of lead those conversations on a daily basis. They're looking for one thing: good loans, safe loans, and be able to receive passive cash flow on a consistent basis. And being in the private credit space, that's exactly what you can offer them.
Yeah, that's interesting. And are those New York-based family offices?
I would say most of them are New York based. I've seen a lot of South Florida, right? Groups. I've seen a lot of Texas groups. I've seen a lot of groups from Israel. I've seen a lot of groups from Canada that have been kind of pouring in to America. I say it jokingly every time I speak to the Canadians, it's the 51st state. Want it or not, it's happening, right? So all our Canadians, we love you guys. But nevertheless, I mean, it's there's a lot of groups that have been kind of attracted to the private credit space in the U.S. because of all the different shifts in the space, right?
How big is the private credit market? So we talked about the rise of it from from the perspective of lack of capital from this normal banks and Fannie, Freddie, Ginnie Mae, FHFA, VA, SBA. Why would somebody not go and get the SBA loan instead? What limits them? Are there any criteria or guidelines that they would not be qualified for?
So to answer your first question, as far as how big is the space, I mean, I think, 2017, there was a study made and it was right around 500 billion, right? Today we're looking at, I think a little shy of 2 trillion, right? I mean, it is a huge, huge space in terms I'm sorry, not 500, 500 billion. Today we're almost at shy of 2 trillion. So it's grown. And I think the main reason why it's grown is back to that point of Wall Street is entering Main Street, right? There are so many groups that I've been speaking to on an almost consistent basis that want to deploy capital, right? They want to be able to put money into good loans, but they're not sure how to do it, right? There's some groups who just want a forward flow agreement. There's some groups who just want to buy pools of loans that they just want to be able to cherry pick. And there's some other groups that, are household names, all of them, in terms of the hedge fund world and the family office world. All they really want to do is be able to buy out a group like ours, right? Because then they have everything kind of in one vertical, right? Everything in house, where they're able to originate the loans, they're able to service the loans, they're able to package the loans, they're able to then securitize the loans. And there's been a huge uptick in securitizations, specifically now in the rated securitizations of our space. When I started buying, selling, flipping, developing in, late, I would say 2011, 2012, there was no real institutional kind of private lender, right? There was your Israeli kind of old school guy that would pull up on his Mercedes, take a look at the asset and tell you right then and there, here's my attorney's information. I'm giving you X, right? Today, that's no longer the case, right? I mean, there are groups out there that are chasing these type of loans, and that's been huge for myself and my partners, but also our investors in our fund, because that gives us the flexibility in the event that we have to sell our loans, in the event that we have to kind of be moving from left to right. We have the ability to be able to do that because of all the interest in our space.
That's interesting. And let's go back on the SBA loan comment, right?
Okay.
So why would somebody not be qualified for the SBA loan on these type of things?
So it's a very good question. So, my sister, she's based out of Wisconsin, and she is in a group home space, right? She does a lot of SBA loans. And I was actually on the phone with her last night, and she's like, Ruben, it's such a nightmare. It's been 4 months. I've given them everything, including my blood, right? And my firstborn child, and we're still not approved. Worst case scenario, if I buy this property, I'm buying it with she's buying the business and the real estate. Will you be able to bridge me for the real estate acquisition? Obviously, we could, depending on a number of circumstances. But her whole point is that she's been in the process for 4 months and she still can't get the financing, right? And she is an A-type borrower. She has perfect credit, good business. She's been in this space for many years. First, she started as a social worker for the state of Wisconsin, and ultimately kind of grew from there. She can't get the I mean, she has a few SBA loans, but it just takes a long time.
So really, government is not in the business of making money, right? They don't care.
You know, sometimes it kind of feels that way, right? It definitely feels that way. It definitely kind of portrays that, but I wouldn't say that. I think it's just a matter of process and timing. And I think a lot of our borrowers today, when they think of SBA, they think, oh no, I don't want to go through that process. I mean, they almost kind of cringe when you talk about that. When they're coming to us, they're coming to us because they have a few days to close. They have maybe a week or 2 weeks to close, or they just have a contract that has no mortgage contingency. So they don't mind paying, a little bit of a premium to use a private lender, buy that property, reposition it, and then go into a term loan with an SBA lender, an agency lender, or what have you. Because when they're able to do that, they've already repositioned a property to a point where it is stabilized, it is cash flowing, and the value of the property has appreciated so much where they're not only going to be able to take out the money they put in, but they're probably going to be able to take out more. In addition to speed, right? I think a lot of times the properties that our borrowers or clients are buying, they're sometimes not mortgageable, right? It's could be missing a roof. It could be a fire damage, water damage. I mean, it's a number of things, right? And outside of the timing, it's just the asset itself, right? So I think combining those two in mind, it really has been given us a lot of opportunity. In addition to that, I think a lot of regional banks, SBA lenders, they've been repositioning the way in which they're looking at CRE, right? Commercial real estate. They are shedding and trimming a lot of their loans. They want to get rid of it for a number of reasons, right? There are regulators out there who are saying, hey, you have to have this amount of liquidity. You cannot have that amount of exposure. So as a result, they're shying away from it. That brings a huge void and vacuum for private lenders to be able to take up a lot of that space. And I think that's why you've seen the business, the space itself mature from 500 billion, not 500 million, 500 billion to almost $2 trillion. That's huge.
Yeah, it is. And in fact, I looked at some of the numbers this morning. The outstanding student debt was 1.8 trillion. The HELOCs and home equity tappable was 34. So that's significant part of the market. And certainly that would attract a lot of the Wall Street firms. Now, if I don't know this market, so I'll be guessing. So folks that would be playing in this market, in my mind, and that would explain some of the shift that I've seen from some of the bigger players from the 2008 crisis, 2009 crisis, buying RPLs, NPLs into the commercial space. So those are Starwood, Colony, Goldman, Deutsche Bank, Blackstone. Who am I missing?
It's a very um I got to tread carefully there because there's a lot of NDAs that we have in place. So it's hard to answer that question and be very honest with you. There's a few other groups that you are missing. I mean, KKR I know is very active
Sure,
in this space, right? I know at some point or another, Fortress was very active in this space,
that's right.
right? I know BlackRock is active. I know Blackstone has been super active. I know you mentioned them as well. There's a lot of groups that have been kind of attracted to this space that have been pouring money. Question is why, right? What why is it? Why all of a sudden are they also attracted to this space? And I think that the space has evolved to a point where you can actually follow specific metrics, right? When I was borrowing money, in like I said, 2011, 13, there was no credit check. We didn't do an appraisal on any property. We didn't do a background search, right? Against me, right, as a borrower. They didn't even know what a background was, right? They didn't even know how to check the credit. An appraisal, forget about it, right? The investor would come take a look at the property, will say, yeah, I like it. I'll give you this much, right? Now the space has matured where it has become a bit more institutional. And I remember in 2013, there was a private credit fund that was based out of Great Neck, New York. And they called me and they said, you know what, Ruben, we see that you're an active real estate investor. We know you're borrowing from the true hard money lenders. We want to be able to offer you capital. In fact, we're probably going to be about 300 basis points lower than what you're getting today. And I said, okay, great. You got my business. Let's do it. I have this deal in Bushwick, New York. I want to get financing on it. And they're like, okay, great. Send us your scope of work. Send us your picture of your photo ID, your social security number, and we're going to send you a document. You're going to have to fill it out. I said, wait a second. Social, photo ID, scope of work. What are you talking about? He's like, well, the only way that we're going to be able to lend to you is if we go through this entire process. That time, I would not go through that process. And I think that a lot of groups at that time had a really hard time actually adjusting to this space. And that was when really Wall Street had started entering Main Street and the private lender space. But I think there was a huge adjustment for private lenders, private investors like ourselves at that time to be able to work with them. Today, that's no longer the case. People, private investors, real estate investors are totally used to getting their credit check, doing a background search, doing appraisals on the property, right? Getting and done, doing the scope of work. They're used to it. Whereas before, they were not.
Well, there's a reason why, right? Securitization entered into the space, which forced some of the rating agencies on the commercial side to issue the guidelines that all the loans to be securitized have to go through those checks and balances, the credit, the appraisal, the certification, errors and omissions of the appraiser, etc. So the Wall Street dictates on how the money flows through the system. I'm being lucky to be on the securitization side and monitor all this stuff, but it's very black and white, right?
Yeah.
The loan does not get securitized if it doesn't pass the smell test,
And
and
you have boxes to check off, right? I
that's
mean,
right.
it's a very good point that you made. I mean, I had a borrower that bought a property not too far from where I live, and he said, "Ruben, I gave him financing, and he said it's time for me to do a construction draw. I just did $100,000 worth of work. Can you wire me 100,000?" I said, "Sure, no problem. I'll send my inspector in there and confirm." He's like, "What are you talking about? Send an inspector in there? You were just here 2 days ago when you were walking over to your house. You saw what I did." I was like, "Yeah, I get it, but I still have this box to check off. I know you did the $100,000 worth of work. I was there with you. I get it, but I still have to check this box off." And I think the main reason to that, again, to your point, is because Wall Street is dictating how this business is operating. Now, the flip side to that is a lot of our borrowers are complaining like, well, there's too much red tape. It's starting to grow. What do you need you need an inspector for? What do you need an appraisal for? Some borrowers are accepting of it, but then they start, when you tell them, well, your cost of capital has dropped by 300 basis points or 400 basis points from your true hard money lender, all of a sudden their sentiment towards it changes.
Yeah, I agree. Now, let's talk about sweet spots of the market, right? So we talked about somebody knocking on your door and asking for a bridge loan, but if you look broadly to DSCR, RTL, fix and flip, where do you see the biggest growth? Where do you see the potentials for somebody that's looking from the outside in to start lending into that market? And since you've been there for such a long time, what do you see?
So I think we've touched on this a little earlier, and I'm happy to delve in a little bit more. So I think a lot of what we're seeing is the non-QM space growing significantly. And it kind of reminds me of like a 2008 kind of subprime market, right? Where all you really needed was a pulse and a photo ID and a social security number, and you got yourself a loan. Obviously, it's not the same. There's a lot more that comes into the underwriting today than it did before, right? I mean, but it there's been a lot of entrants and a lot of people, a lot of groups coming into the non-QM space, specifically in the DSCR, right? The debt service coverage ratio loans. I mean, I think at this point today, 29% of all non-QM loans is our DSCR, right? And there's a reason why. The product actually works, right? And I kind of made an analogy to the subprime market, but really the product works from a perspective of you're not looking at the borrower's income on a personal level. You're looking at the property's income. And sometimes that's far more valuable than the borrower's income himself or herself, right? Because if the property is able to produce X amount on a monthly basis and your debt is a portion of that income producing property, well, then your debt is almost always certain to be paid. The question then becomes, well, what if those numbers are inflated, right? What happens then, right? And I think I don't want to mention, any groups or anything like that, but I think there's been a huge shift and vibration in the space today because there was a couple of groups that came out with a bunch of deals at one time and numbers were inflated, right? And I sit on the advisory committee of the National Private Lenders Association, right? Run by John Hornick. I'm not sure if you're familiar
I
with
do.
that
I know,
association.
John.
You need to join it if you're not. It's amazing. And what we're noticing there is that there's a huge uptick in potential fraud when it comes down to appraisal evaluations and the rental evaluations. And I think that being a regional focused lender, private lender, when you're doing these type of loans is super important. Because look, if you're going to come to me and you're going to tell me that property, that three-bedroom apartment or unit in Brownsville, New York is going to produce 6,000 a month in income, I will tell you right off the bat, no way. Right? Why? Because I know the market. I know my backyard, right? But a lender that's coming out from other states like Texas or South Carolina, no, they won't know that, right? They're just going to take their word on. They're going to take the appraiser's word on it and what have you, and move on. And that's why I think today it's very important to be focused on your area, focus on the region that you know best, but that's your point as far as what's happening in the space. Yeah, the DSCR is just taking over, right? You don't need any bank statements in terms of what is a person producing. You don't need their tax returns. You don't need their W-2. Yeah, you still need good credit, right? Because you want to make sure that he is a good person. You still want to check their background and you want to make sure the property is producing enough income. Now, the question then becomes is, does the property need to be producing the income? Well, the answer is no. You can go based on projections, right? Because a lot of times our borrowers they're buying properties, they're fixing them up, and ultimately they're renting them out, and that could take time, right? If you have a 4 unit property, you might have two of them rented, and the other two you're still looking for a tenant. You don't want to rush to get a tenant, so you'll go based on the projection. So I think that flexibility of current rents, projected rents, and that flexibility of not looking at their tax returns, W-2s, really has shown the demand, but also the validity to that program.
Yeah, something that I wanted to mention. I'm actually glad that you mentioned the Baltimore City story, which is a public knowledge now where a multiple LLC were selling the properties to each other, inflating the appraisal values of the property, working with the um fake appraiser for a fixed amount of money. In fact, I'll host the guy from Dominion Financial on a podcast here in the next couple of weeks to talk about a few ways to uncover the fraud uh, when you are the nationwide lender and you're not local, and now you have to suffer the losses just because you don't understand where the property is located on the border of good or bad or the rental max, and you rely on some of the online resources which are frequently inaccurate.
Yeah, yeah. And look, I mean, what we do internally when we see an LLC transferring or selling to another LLC, we make sure to do a background search on both, right? We look at the principles on for the selling LLC or entity for and the principles behind the buying entity. And the reason why we do that, and sometimes again, our borrowers are like, "Why do you need me to get you the operating agreement for the seller's entity?" Well, that's because we already have a red flag, right? And that means I want to make sure that the owners and the operators behind the entity for the seller are not in any way connected to the buyer, right? So we do background searches on both. And if there's any type of connection, whether it's a mailing address that is being used, right, or anything to that effect, is some kind of, and sometimes you'll see, oh, shoot, they're relatives, they're cousin, they may be potential cousins or something like that. Red flag, denied, see you later, blacklisted, we're moving on, right? And that's very important. Is to make sure your underwriting is airtight. But obviously things do happen, but you got to do whatever you can to cross every T and dot every I.
Yeah, in fact, I proposed to the MBA a way to flag blacklisted appraisers.
Yep.
So this is super important where each lender individually, they carry their own list. It's a completely separate database.
Fragmented. Everyone has their own lists. We're working on that NPLA as well. It's a very good point, Alex. It's a very good point.
Yeah, so from my perspective, the fraud in the appraisal could have been avoided if one of the lenders notified a group of lenders, "Hey, don't use this guy because he always inflates or deflates, or it's hard to work with, or whatever," and that doesn't exist. I think in some avenues of the lending industry, the title research or title companies, they have blacklist sites that list those, not appraisers. So that's very interesting to me, especially when we deal with different lenders, they give us the underwriting guidelines and their own blacklist of appraisal. So we don't cross-reference the blacklists from one lender to another. So that's a big hole and the risk level as well.
Right. I wonder, I mean, one thing that we're challenged with right now is how do we deal with defamation, right? I mean, if a lender they might just not have a good relationship with an appraiser, right, or with a borrower, and for whatever reason, right? It may be personal reasons, and they put them on that blacklist, and then it's shared with everyone, right? What happens in a situation like that, right? I mean, that is, I mean, look, I am an attorney. I'm not really practicing on a day in day out basis. I do a lot of legal work for WeLend, but what happens in a defamation situation like that? I mean, I know you've made that proposal, but like, how did you guys work around that with MBA?
Well, it's still a work in progress. There's a need for it. There's no
There's a
perfect solution. Yeah.
huge, not only appraisers, not only borrowers and like that, but it's also title companies, right? I mean, huge problem there as well that has to be navigated.
I actually know a few that got blacklisted everywhere by just disappearing, one selling to another, to another, to another, and then, when you
Scary.
knock on their door, "Hey, where's my policy?" They didn't pay for it. So the policies that are not paid avoidable, and you think that your property is insured? No,
It's
it's
not.
not. So if you don't get the final policy in your hands, you never know that the policy was paid for and truly is covering you for anything that happened at the time of the closing. So a lot of those stories I hear, I'm sure you too.
Right, right. All the time, all the time. I mean, especially when they're involved in that whole, a sign here, a sign there, notarize this, notarize that. It's a problem. And the other issue is that, like, as a private lender, I can't really recommend or force someone to use a title company that I know and trust, right? I know the founders, I know the company, right? I feel comfortable to say, okay, they cross every T, they dot every I. And there are laws behind it where it says, hey, you can't force or require or recommend to your borrower to use this title company. I think that something has to start. We as the industry players have to start thinking about how to change that law.
Yeah, agreed. Does the National Association of Private Lenders a good place to start? I know that that organization was growing quite well. My buddy George Caballero always goes there, and
Big guy.
George, I'm sure, and a lot of the players like Torak, like Rock Capital, Lima One, and others. So you have the smaller guys that are participating in that conference. How do you see that conference growing, and would you recommend somebody to attend? I think they have almost bi-monthly conference in the
So
different
I
parts
think,
of.
yeah, I think it's almost every 3 months, so every quarter.
Okay.
So they had maybe about 4 or 5 conferences a year. I would highly recommend the NPLA. In fact, Wieland was born at the NPLA. I went to at that time it wasn't the NPLA. It was called the Pitbull Conference at the time. I was in law school, and I got a call from my dear friend Leonard Rosie. At that time, I didn't know him, but I got a call from him. He's saying, "Hey, look, I see you're a blue chip kind of lender, investor rather." At that time, I was buying, selling, flipping, developing. If you're an investor, you got to come to my conference. There's a bunch of private lenders out here. You're going to find a cheaper source of capital. This was right before, I think it was like my last semester. It was my last semester, and I was about to start studying for the bar. So I said, you know what? Why not? I got nothing better to do. I need some time off. Let's fly out. So me and my partner Moses, we flew out there, and we came to this, at that time, Pitbull conference. Today it's the NPLA conference. We went into this conference as private investors. We walked out as private lenders. And, that was in, I would say, late 2017, early 2018. Since then, we've originated 700 million across, almost 1,400 loans. And the only way that we were able to build the company the way in which we built it is through that conference, right? It has helped us tremendously. I mean, this is not a promotion in any way. I mean, I'm just giving you my personal advice.
It is a good conference. I was on the fence by
Yeah.
sponsoring it or attending it, and I regret that I didn't, because a lot of the good players came out of that conference on the market that I deal with today, and certainly one of the regrets. I typically sponsor the MBA conferences and IMN conferences. Pitbull was always sort of for me to a bit smaller than MBA, but at the same time, it grew into a larger private lender conference, and I know all the players that attend, so it does make sense to start there. And if you're looking for business connections, certainly it's a good conference to
That's
be
the
at.
place to be. You have lenders there, you have brokers there, you have loan buyers there, you have capital providers there. I mean, there's a number of groups that come together.
Yep, very good. So I wanted to sort of wrap our discussion up with two things. One is, what are your thoughts on people playing this market, right? So if somebody is complaining that they don't have enough deals, they don't have enough mortgages, they don't have enough properties. There's so many variables involved, either from investor or lender's perspective. How do they play in the market that you see a huge opportunity and a growth in? And second is first of all, how do people contact you, and why would people contact you um, when they find us on the YouTube and other channels?
For sure. So a lot of our to your first question, a lot of our borrowers today, a lot no, I'm sorry, a lot of our investors in our fund today are actually our borrowers, right? At some point they borrowed from us. And then what ended up happening is that as they were borrowing from us, the deals became a little tighter. Margins have compressed, right? And the deals where they would make, 50% ROI or cash on cash on their money are now at like 15% or 20%. And the amount of work that comes into it just doesn't make sense. So what have they started doing? They started saying, okay, you know what, Ruben, we know your underwriting is airtight. We know you cross every T, you dot every I, and you want my firstborn child, right? We feel comfortable to give you money. So instead of us waiting to find a deal, we'll invest alongside you or into your fund. That's worked tremendously. So I feel that a lot of people who are in the space on the sidelines and just can't find a deal to put their money behind, they need to find another group that they can actually invest in where they're seeing a lot of deal flow, right? And it doesn't have to be private credit. It could be private syndications, private other private groups that are in the business of deploying money on a consistent basis. So that's, I hope, answers the first question.
Yeah.
As far as your second question, how would they find me? They could always reach me at my cell, 917-815-1222. They could visit us at our website, www.wheelandllc.com. And why would they reach out to me? They would reach out to me only if they need fast and quick cash to be able to buy their properties, fix them up, and flip them.
You're very brave by giving your cell phone number on the air, but yes, so certainly Ruben is a well-known lender and investor. If I would definitely recommend to go and visit the conference and schedule some time FaceTime with Ruben while you're there. I think I'll probably go to the next one. I believe it's in Boca or
Yeah, I think the next one is going to be in Arizona.
Arizona. Okay, yeah. All right, very, very good. Ruben, again, thanks a lot for coming to the podcast. A lot of interesting topics. Anything, less words that you want people to know? And what?
Thank you so much for putting this together, and forgive me for not being able to make it on last meeting. I put it out on the air because I felt horrible. I messaged you like an hour before saying I had a family emergency that I can't make it. So forgive me for that.
No problem whatsoever. I'm glad we did it. We're synced up, and let's do it on a regular basis.
Looking forward. Thank you.
Sounds good. Thanks, Ruben. Take care.